So as Kathy mentioned, Qarar is in the business of advanced analytics. So I'll be focusing on the role that analytics and automation play in digital banking. I'll cover a couple of use cases, and then I'll leave you with our thoughts on recommended next steps that you can take. I'll be adding my own spin to the effects of COVID-19 on digital banking. But first, let's agree that the need for digital services was not born out of the current crisis. I mean, the current crisis has definitely helped in accelerating that drive, especially within financial services. But the initiative has been going on for some time. I mean, we've already seen contraction in branch usage versus usage of digital channels. We've already seen a gradual decrease in the use of cash versus other forms of digital payments like Apple Pay. But the drive for digitization was usually fueled by the desire to improve profits, from a combination of increased revenue as well as lower operating costs. However, amongst the biggest drivers now for digital transformation we see is to transform the customer experience, because according to Forbes, 63% of consumers said that they will pay more for a great experience, especially those consumers of Gen Z and the millennials demand instant gratification and are willing to pay for it, as Amir also alluded. So enter COVID-19. So the way we see it, COVID-19 served a number of purposes that are related to us. One is it served as a wake-up call for many of the late adopters, especially in our region, the GCC and Middle East. And it pushed them to play catch up and start realizing some of the great results that leading banks have been enjoying. I read somewhere that in China and Italy, only 4 weeks after the coronavirus broke, the increase in digital engagement shot up by 20% just in the first 4 weeks. The other thing that COVID did is that it brought in a new customer segment into the digital space, the 60 to 85 age bracket that many banks have traditionally lost hope in converting. These now are customers sitting at home and therefore forced to adopt digital channels. The banks need to now think about the digital needs of that entirely new segment. The biggest impact we see really is that it forced banks to start thinking and go beyond the most basic and common digital features, beyond authentication and quick balance checks and easy transfers. Now banks have started to follow a more needs-driven approach and forced to identify digital features that are relevant to their own base and relevant to their own market. I mean, let's take, for example, in this financially stressed environment, all of the customers are now demanding from their banks digital services around credit terms, around the ability to apply for a late fee waiver or reduce the minimum payment, or permission to skip a loan or apply for a payment holiday, etc. But regardless of whether it's a late adopter or an established digital bank, regardless of the impact of coronavirus, I mean, one thing we see that holds true is that in order to achieve this ideal desired level of, let's call it, digital proficiency, it requires a combination of advanced analytics as well as process automation. And it equally requires the focus to digitize not just the customer-facing touchpoints, but also the back-end business processes. But we know that not all business processes are created equal. So the benefits from automating a back-end process increases in direct proportion to the complexity of information that it uses and the number of decision points that it requires. I mean, according to one McKinsey report, they identified processes such as mortgage origination, SME account opening, credit card onboarding, as those that hold the highest value potential in terms of cost saving and productivity if digitized. And these include, automating processes such as the ones used by credit underwriters and loan officers, so that they can interact seamlessly during the loan application process. Equally, the dependency on analytics or model development plays a big role. I mean, let's take, for example, risk models, which are key in teaching automatic decisions, especially in the gray areas of loan approval. There are many examples, and I'll come later on to a couple of use cases, but other examples of models that play a big role in digital banking are pricing models that allow banks to determine special offers that they want to push to high value clients and do that in real time. So I want to take a closer look now at these two components, analytics and then back-end decision automation, and how they fit into the digital strategy. But so advanced analytics, which in our definition covers the domains of predictive and prescriptive analytics. And these domains have been enabling really superior performance in organizations, especially those organizations that are willing to make proper commitment and investment in these tools. And banks and banking industry in general have been deploying advanced analytics for some time now to move their business forward. And usually it's one of the three reasons that they do that. One is to accelerate growth, such as in the area of sales management by applying things like propensity models and cross-sell models, or to improve risk management, such as in the area of credit underwriting by the use of PD models. But one of the biggest drivers recently has been for the delivery of a digital bank, or the delivery on the promise of a digital bank. And the reason why analytics has been able to play such a big role in digital banking is made possible, obviously, first by advances in technology. So we know that the availability of information that's available now for mining is booming, but also advances in analytical techniques have also improved considerably. Beyond the traditional linear regression techniques, we are now deploying machine learning models that use random forest techniques and other advanced algorithms. So really applying analytics truly can help deliver on the promise that digital banking makes, because it enables this enhanced customer experience, which we saw from studies is kind of one of the main drivers for customers and banks alike. So to achieve that, banks truly need to start gathering real-time data and use analytics to better understand the customer and build proper journey. But what we've seen from our experience and really working with a number of firms in this region, and maybe I think it would be a similar challenge, globally as well, is that a lot of firms seem to face a challenge in turning their analytical insights into business outcomes, and the challenge really comes because they want to figure out, how can I extract the full value from my analytical investment? And usually we've seen this happen because organizations miss planning for that final stage or the last mile, which is figuring out how these insights will be delivered, how will they deploy or be deployed, how will they contribute to the decision-making process. And this is where we feel and recommend that banks consider embedding automated back-end decision engines in every digital journey. And it's exactly why while you always will hear Qarar say that every digital platform needs a powerful and robust decision engine in the background that can help it deploy, the decision logic for any use case, be it a cross-sell opportunity or fraud detection or credit underwriting. And we've seen many banks and lenders and fintech, they embark on rolling out their digital platforms. They realize that these are brilliant digital platforms, but they focus a lot on the onboarding, on the authentication. But usually they don't come with the back-end decision engine sophistication that is required to achieve an end-to-end journey. For example, here kind of a digital lending journey, for example. So these decision engines, they need to come with a set of minimum features. First, they need to be user-friendly, allow the user to create, amend, implement rules and policies on the fly. They need to be able to support real-time decisions. They need to be able to deploy and support unlimited number of scorecards and models that are used across the organization. And they need to be able to support these models being developed in any language, whether it's R, Python, SAS, Excel, whatever. They also need to be able to call and receive data from third parties, and not just that, but also create new characteristics from this data. And it's these new characteristics that really drive the performance of these models. They need to also be able to configure any decision logic. What are the best terms to offer, the best price to offer, what action to take, what product to push. And obviously, they need to also be able to support cloud deployments and have open APIs, create one cohesive decision system. And this is why, and the main driver for why Qarar has partnered with Aion, so that we can integrate our decision engine, Decision Smart, with Aion's digital platform and offer a turnkey solution. Moving to our use cases. So the first use case is a cross-sell use case. And we know that this is a top priority for a lot of clients in the region, and rightly so, because one McKinsey study shows that leading banks were able to achieve a digital cross-sell penetration of 49%. That's 5 times more than slow adopters. And they were able to achieve that by including features such as customized push notifications and personalized offers. In one use case, for a personal finance company that we've come across in the Kingdom of Saudi Arabia, they were able to apply propensity models and capitalize on the use of third-party credit bureau data and combine that with internal CRM data, such as demographic data, client and product related data, and even digital behavior data, meaning when does the customer log in, what digital services they use. And they were able to use all of that information to create very fine micro segments, and then use those segments to push pre-approved offers to these individuals. They could even go further by tailoring the communication to each of these micro segments, so that setting the right tone of voice or the best time to contact the client, which really helped increase their sales while maintaining a high customer satisfaction, which is the key objective. The other use case looked at digital lending, and this is now a priority for banks, especially in our region here. And this includes the digital transformation of the entire end-to-end credit journey. And not just the customer experience, but also every single supporting credit decision point and credit decision process, because credit is so core to customer bank relationship that digitizing it offers significant competitive advantages to banks. When it comes to collateral-based lending, for example, such as mortgage origination, we know that this is a process that has the highest potential of gain if digitized, because the current process, as we probably all know, can take 10 to 15 days and can carry up to 45% of the origination costs with multiple touch points. In KSA alone, mortgages represent more than 51% of total retail credit. So there is no surprise that it has been one of the areas that have seen digitization even before COVID-19. What happened now after the current crisis is that the demand for digital credit also grew, whether on the collateral-based lending or not. In that successful use case, we found that the key here is to redesign the lending process from end to end and eliminate every single manual step. Because we found that without an end-to-end solution, banks will always see disappointing results. And this includes the framework for making credit decisions internally, including the full risk assessment process of the applicant in real time by using third-party sources such as credit bureaus and other governed public data, and developing very strong internal credit risk models, either by using internal data, but also capitalizing and using alternative data such as mobile device information or psychometric data to rate customers. Obviously achieve complete automatic decision making and offer a comprehensive product and offer capability so that they can put the right product to the right customer at the right time and offer him real-time approval or even approval in principle in the worst case. So finally, I'll leave you with some parting words and recommendations. From our opinion, to capture the full opportunity of digital transformation, we feel that banks need to first focus on those processes that can benefit the most from digitization and bring in analytics because it has a high impact. Digital transformation, we feel, can only happen when AI is embedded to support both the back end process but also the customer facing functions. The second step is to set the right technology roadmap. I know that not every bank or lender has the luxury of starting from a clean page. So some trade-off is involved, between cutting-edge technology and legacy systems. There's one survey done by Cornerstone that showed that 70% of banks said that their institution's current infrastructure was one of the key barriers to digital transformation. And finally, and I think that's something a lot of you have already heard, which is the importance of change management or creating that buy-in and adoption inside the organization across all levels, starting from executives, but also IT and business. That same survey also showed that corporate culture was another barrier to transformation. A lot of organizations said that they were very dissatisfied with progress, especially surprisingly in credit underwriting. And they cited reasons like insufficient cooperation between teams and limited availability of data or limited availability of talent. So thank you very much. We hope that was helpful. We hope that once COVID crisis passes, the organizations don't take their feet off the digital transformation pedal and continue building on this momentum.